Good afternoon. My name is Margaret Mueller. I'm the president and the CEO of the Executives Club of Chicago. Thank you to the shushers. Well done. It is my pleasure to welcome you all to today's 40th annual Economic Outlook. Last year, it was just my second day on the job. I've now been here 1 year. I've gotten to meet many of you, but not all of you. I look forward to meeting all of you as soon as I can. And I know I speak for all of us at the club when I say it's been an honor and a privilege to serve our members in the greater Chicagoland business community this entire year. Thank you for that opportunity. Before we begin, it is my pleasure to announce our head table guests. Michael Albers, Chicago Sales Director, American Airlines. Robert Gabriel, Campus Director, University of Phoenix. Julie Holtz-Richter, Chief Operating Officer, CME Group. Teresa Wilton-Harmon, Chicago Officing Managing Partner, Sidley Austin. Melissa Bean, President and CEO, Mesereau Financial Wealth Advisors. Bob Arthur, President, Magellan Corporation. Sharon Oberlander, Managing Director, Wealth Management Advisor, Merrill. Rahul Shah, Chief Executive Officer, Catalyst Technologies. John Martin, CEO Emeritus, Antares Capital. Dan Ryan, President, Central Region, JLL. James Kolar, Central Market Managing Partner, PricewaterhouseCoopers. Tom Kuntz, Chief Executive Officer, United Healthcare, Illinois. Daniela O'Leary-Gill, Executive Vice President and U.S. Chief Operating Officer, BMO Financial Group. Linda Imonti, Office Managing Principal, KPMG. Scott Robinson, Managing Director, Robinson Resource Group. Scott Swanson, President, Illinois, PNC Bank. Geoffrey Gundlach, Chief Executive Officer and Chief Investment Officer, DoubleLine. Terry Savage, National Syndicated Columnist, Terry Savage Productions. Diane Swonk, Chief Economist, Grant Thornton. Dr. Bob Froelich, owner, Kane County Cougars Baseball Club and former Vice Chair, Deutsche Bank. Tanise Paul, Chairman, Energy BBDO. Mary Dillon, Chief Executive Officer, Ulta Beauty. John Prince, Chief Executive Officer, OptumRx. James Zally, President and Chief Executive Officer, Ingredion. John Conroy Jr., Principal, Baker McKenzie. Larry Richmond, Chair, U.S. Region, CIBC Bank. Marcia Cruzan, Regional President, U.S. Bank. Michael Flannery, Chief Executive Officer, Duchossois Capital Management. Wayne Bush, President, Financial Services, NTT Data. Craig Bartholomew, Executive Director of Illinois, United Healthcare. Eric Reeves, Managing Director, Head of Private Capital Investments, Duchossois Capital Management. Carl Vanderwilt, Retired Chairman, Chief Executive Officer and President, SunTrust Bank. Francine Manilow, Owner and Chief Executive Officer, Manilow Suites. Michael Capone, Partner, Grant Thornton. Thank you all for being here today. Thank you for your support of the Executives Club. You may take your seats. So this is obviously the club's largest and most anticipated program of the year. And I'd like to take a moment not only to welcome you, but to thank you so much for your continuing support, both of the Executive Club and this annual Economic Outlook. Today marks an exciting moment as we celebrate our 40th anniversary of this renowned program, which has had Terry Savage as our dynamic leader since the program's inception. The fact that this room is continually sold out is a testament to our phenomenal thought leaders and moderator, as well as the fascinating economic times in which we live today. Now I'd like to direct your attention to the screens as you acknowledge the names displayed there, because an extraordinary program of this size simply would not be possible without our sponsors. So first, our platinum sponsors, BMO Financial Group, KPMG, Robinson Resource Group, and United Healthcare. Our many generous gold-level sponsors, whose names you see on screen now, thank you all so much for your support. And our silver sponsors, thank you very much for your support. Our media sponsors, the Chicago Latino Network, the Wall Street Journal, and WBEZ, and our technical sponsor, Shure. Please join me in thanking the many companies whose support make today's program possible. I personally also want to thank the club staff. They work behind the scenes. You do not always get to see what they do day in and day out. You would be absolutely amazed if you saw the small and mighty team that works tirelessly to put on this program every year. It does not seem possible. I still don't know how they do it. They are absolute superstars. I'm lucky to work with them day in and day out. Thank you all so much. Thank you, team. And finally, if this is your first time at an Executives Club event, thank you for being here. We'd love to welcome you into our community. We have many exciting programs coming up, which are both mentioned in your program and will be seen on the screens while you enjoy your lunch. I hope that we see you at one or more of these many exclusive conversations. So now I invite you to enjoy your lunch, continue your discussion with your table mates, and we'll be back in a few moments to begin our program. Thank you.
40 years. I find that astounding myself. I say that every year. I say, I can't believe another year has passed. Well, 40 years, and now we're at the start not only of a new year, a new decade. I wanted to set aside the program for a second, and on a personal note, thank you all for your support all over these years, not only in attending this luncheon, but in watching the TV shows. It's WGN Morning News now and WGN Radio at noon. And thank you to the Tribune people who are here, my editor, who edits me every week. That they syndicate my column. And I thought I could think of no better way to say thank you than to give you each, and that includes, by the way, all the wait staff too, a copy of the brand new, hot off the presses edition of The Savage Truth on Money. So I hope you will use it and enjoy it. Sharing financial information is really my lifetime passion. I'm really fortunate that I get to live my life doing my passion. It's also my business, so you'll note there's a bookmark inside, and if you flip it over, you'll see that what I really do is go out to companies like yours and create a program based on your employee benefits and basic personal finances. So your coupon is your discount ticket to calling me for a presentation and books. I'm sure you'll enjoy it. That's enough of a commercial. Well, now on to the business at hand. We meet today for our 2020 forecast with the stock market just within spitting distance of its all-time highs. In fact, all the major averages within a few points. The Dow this morning and the S&P were up at new highs, and the NASDAQ as well. This is a year in which, for the calendar year last year, the S&P 500 rose a near record 28.5%. I'll bring you my charts in just a moment and show you for comparison. But first, let's just take a look, get some perspective so we know where we've been, we can see where we're going, or where our forecasters say we're going, at the year behind us. This was a year in which the Fed did a very sharp U-turn. After raising rates 4 times that's okay, you don't have to put the thing up. People in the front can't see, so if you take that slide off for a minute, and we'll put the other ones up. This is a year in which the Fed raised rates 4 times in 2018. Remember last December, that triggered a nauseating stock market slide at the end of the year. It was horrible. And then the Fed changed its mind and actually cut rates 3 times this past year, and they also forecast rates would be unchanged for 2020. But it wasn't just the Fed that roiled the markets and the economy in 2020. In 2019, we had the on-again, off-again, on-again, off-again tariff promises and threats and breakdowns of talks to contend with. Perhaps the just-signed tariff agreement will remove trade as an issue for 2020, at least until after the election. Oh, by the way, speaking of the election, yes, it's happening this year, and despite the Middle East, economic issues are certain to be front and center. The Democrats have moved mostly to the left, and we now have a younger generation of voters who do not think that socialism is a dirty word. And the Republicans on the right have promised more tax cuts and, by the way, a sitting president who's in the midst of an impeachment trial. Now, what could go wrong for the economy and the markets with all of that going on in 2020? Looking back at the markets, last year proved that selling stock to the public was not instantaneous fortune-making. Uber and Lyft IPOs proved, not the road to riches. And WeWork just didn't work. Financial fads always change. 2 years ago, it was Bitcoin. And last year, it was cannabis. And now it's plant-based foods, specifically Beyond Meat. And also, this looks like the year that corporate America comes to accept and embrace the reality of climate change. It only took a 17-year-old Swedish girl and Australia burning down to make that case. Finally, and back to finances, no one seems to have noticed that we just added more than $1 trillion to the national debt this past year. This in a year of strong economic growth and strong employment. So on that note, let's take a quick look back at where we were in the markets last year at this time. So here's the first chart. Dow Jones Industrial Average. Last year, it was horrible. Don't you remember? That was horrible year end, 24,065. It was down 5.6%, the Dow last year. Most came in the fourth quarter. The Dow fell from 27,000 to a low of just under 22,000. On Christmas Eve, it fell more than 650 points. And then the day after Christmas, we had that rebound of the largest one-day point gain in history. That set the tone for volatility in 2019. Last night, well, we do this from our luncheon to our luncheon, not year end. So last night, the Dow closed at 29,196. And again, last year, the S&P gained 28.5%, and the Dow posted a nearly 25.5% return. The NASDAQ had a spectacular year as well. This time last year, it was at 7,023. Last night, 93.70, a handful of points, and today it hit its all-time high intraday. And for the entire calendar year last year, NASDAQ gained 35.2%, and then more focused NASDAQ 100 gained 38%. So you know we do this every year. So let's go back. Let me put the Dow chart on again. Keep that as your perspective. Okay. Now, every year I ask you what your forecast is, what you think. I'm going to have to tell you, just like I mark everybody to the market, you did not do a very good job last year. You know, according to my notes, half of you thought the Dow would spend 2019 somewhere between 24,000 and 27,000. 30% of you, and you know who you are, a full third, figured the Dow would be below 24,000 today. And yes, there were about 20% who thought the Dow would make a new all-time high over 27,000. That's what I asked. Okay, now, I have to make this easier for you. So I won't give you three choices this year. Here's your chance, all right? Do you remember, it hit 29,300 this morning. I think it was about unchanged the last I looked a half hour ago. So just say 29,129 where it was last year. I'm going to ask you first, those who think it'll be higher, then lower, and we're going to just see. How many of you think the Dow will be higher than we are today next year at this time? I got to look and see the other side. How many think it will be lower next year? Well, I think it's 60-40 higher. Am I right? Was that right, Jeff? Okay. I got to write this down. 60% higher, 40% lower, and I keep these notes. Yeah, so please come back next year, and we'll see. Okay, a quick look at some other markets before we get to our forecasters. Just for perspective, because we always ask them to forecast interest rates. Here's the 10-year Treasury note. Despite great economic growth, today it's trading at about 1.78% yield, and that is a full percentage point lower than it was last year. That's really interesting. Now, you know, I always put up charts about GDP, inflation, and unemployment, but they've been so steady, they don't reveal very much. So I decided to put one unique chart up. It might lead us to a more international discussion, and that is gold. Gold's had an interesting 12 months, and last year at this time it was $1,280 an ounce. This year, $1,553, and maybe that says something about the U.S. dollar, and maybe we'll get into how long can the U.S. lead the world. But that's not for me to say, that's for our forecasters. So it is time, the most bullish chart of all, I almost forgot, consumer confidence. Consumer confidence, this goes back now to 1978. While you were worried about the stock market and everybody on CNBC was talking recession last year, consumer confidence, and you can tell by the shopping figures over this holiday season, and consumer debt, has remained stubbornly near all-time highs. So now, let's get to our forecasts. We will ask them this year to forecast the stock market next year at this time. We use the Dow to forecast interest rates, the 10-year Treasury note yield. GDP, is it going to be 2.1 or 2.4? Let's just say, will there be a recession in 2020? We could ask forecasters that. And then in honor of Alex Trebek and Jeopardy, I'm going to give you the Daily Double. And that consists of, I will ask them each to talk about the biggest economic surprise that they think might be in the offing that nobody's kind of factored in. And because this is an election year, let's ask them not who they want. I got to be very careful about that. Everybody demurs at this. But who they think, with their bright minds, will be the candidates, and then who they think will win the election. Plus, of course, the last question, so don't you dare leave early before we close the program out, is always, what would you do with $100,000 today? And I do keep track of that. So a reminder, text EXEC, E-X-E-C. We will take questions at 22333. Again, EXEC, text it to 22333 if you have questions, because your questions make up a great part of the program after our panelists finish. And now let us move right to the start. Our first speaker, as always, is Diane Swonk. Now, as she has for many years, Diane leads off our program. You can take that away now. I'm used to having my directors at, Aline, we're going to have to put you up in the booth. That's Aline, my WGN Morning News director, made it the #1 show in town. We need you up there calling the shots. Yes, thank you. Yes, see? Okay. Now, Diane Swonk she'll tell you how long she's been here. We were just talking about, I've been here a long time. Diane's catching up, sort of, kind of in a way. It's been a long time. She's chief economist and member of the executive leadership team at Grant Thornton. Diane's nationally recognized for her correct and very relatable forecasts on the economy, the labor markets, monetary policy, and structural change. Who listens to Diane? Everybody, from the Federal Reserve Board and member banks to the Congressional Budget Office, the National Association of Business Economists, where she's been named a fellow. But her words are eagerly received also on CNBC and CNN and major business news media. Now, we've known Diane for so long, it's easy to forget her stellar bio, starting as a chief economist at First Chicago, on to chief economist at financial services firm Mesereau, and then the creation of her own company, and for the last 3 years as chief economist at Grant Thornton. And you can't forget all of her moving comments and fascinating forecasts. Last year, at this time, Diane worried that the tax cuts had created a kind of sugar high, she said, that might not last in the face of uncertainty about tariffs and a global slowdown led by China. She warned that policy uncertainty has its own costs, which could possibly lead to a recession in 2020. Well, obviously that did not happen, and Diane's forecast, a conservative 24,500, fell short of the mark, and 10-year treasuries slid. She thought they would rise. But, and that's why I keep track, Diane's picks for investing $100,000 would have made you a lot of money. And I always have to force Diane into stock picking, as you know. But she picked discount retailers Target and Walmart, which had great years, and her Disney pick was spectacular, a huge gain of over 50%. She also recommended cannabis stocks. She didn't tell us which, but I could tell, just judging from the lines in Chicago on New Year's Day, I'm sure they were all very high, those stocks. So on that mellow note, Diane, time for your forecast.
So January 1st, my son came to me and he said, I think I broke my hand. And I took him to the immediate care clinic to get an x-ray and make sure he was okay. He also broke his iPhone. We spent longer time in Apple than we did in the immediate care clinic. But he did notice the lines and asked them how long it was and went back on January 2nd. So there's a dispensary very close to my house, apparently, where there seemed to be a lot of young 20-something men mostly in line, but there were people of all ages in line, and it wrapped all the way around the blocks over and over again. Anyways, what can you do? So today I'm resurrecting something that I once heard, actually, when I was just sitting on this stage and not yet speaking almost a quarter century ago. Back then, I look at the stage today and I realize I think Terry and I were the only women on stage when I first sat on this stage in '94. And about a quarter century ago, there were two words that I think were prescient and mean more today than they've ever meant. And that is irrational exuberance. On the world stage in Davos, our president yesterday said that the US boom was the best the world had ever seen. In fact, he tweeted, it was the best the universe has ever seen, which gave a new meaning to SpaceX and the mission to Mars. Because we must be going to find our interstellar competitors and let them know exactly how good we are. Of course, I do worry about the data we'll collect and worry more about the new definition of illegal aliens in the United States. I'm a little bit more cautious on my optimism. As Terry said, I worried about a recession this year if the trade war continued to compound. That said, I am cautiously optimistic this year, and I'll lay out why I'm cautious in my optimism. One is the stock market is not the economy. This is really, really important because the stock market is less representative of the economy today than it was in the past. In the 1970s, the top largest 100 firms in the country accounted for 50% of profits. In the 2010s, that number was distilled down to the top 30 largest companies accounted for 50% of profits. And today, the biggest market cap in the markets is only 4 firms: Facebook, Microsoft, Alphabet, Google, and Apple. That's a very different place than we saw in the past. The stock market is not the economy. This is also not my first rodeo. I've been humbled in the past by good economies. I've been humbled in the past by long expansions, and I've learned that hubris is a very dangerous thing as the expansion ages. Recession risks have abated, but they've not disappeared, and we're in a world where policy can change in the speed of a tweet. I take particular issue when I hear over the last year people saying they wish that we could have another recession, as if they look at the world through rose-colored glasses on history and forget the arbitrary carnage that comes from recessions. It's not a fast or a cleanse. It is awful, and never wish it for any reason, political or otherwise, because it is arbitrary pain. I became an economist because my best friend went into poverty when we were kids, when her father died. Never ask for a recession, because it will hurt someone, maybe you and maybe someone you know. The expansion started out as a crawl out of a very deep hole, and it has morphed into a marathon. And what it has lacked in momentum, it is starting to make up for in stamina. We're now 10 and a half years in, and I think we got a good chance of making it to 11 to be the longest expansion of the post-World War period. The problem is we need it because the wounds of the Great Recession were deep, and we're still feeling them today. As good as the stock market is, there are other things that aren't as good as they were in the past. And that's important to remember. It means we need to keep the expansion going as long as possible, something the Federal Reserve is now embraced. 3.5% unemployment rate, terrific. Lowest in 50 years. But it's not really comparable, is it, to previous unemployment rates at 3.5%? Because participation in the labor force is not as high as it once was. It's coming back, and it's close to the pre-crisis levels we got in 2007. Almost all the heavy lifting has been done by millennial women. Stop criticizing our young people. They're trying really hard, and they were the hit hardest by the Great Recession. Millennial women are supporting and coming in droves. Some men are coming back too. In prime age, 25 to 54, no, I've aged out of prime. I'm no longer prime, apparently. I just realized that year, and it's this year, and I'm like, I'm 57, so it's been a couple years since I aged out of that. But it's really important is that these prime age people are still disenfranchised. They're coming back, but there's huge scars. There still is a huge loss in terms of deaths that we're seeing out there. I talked about deaths of despair in the past. The number one cause of mortality rates falling in the US while they're rising all over the world is that people are killing themselves, or they've got alcohol-related liver disease, are opioids. And it's now a rural crime, and addiction in rural America is now worse than in some major cities. The narrative has flipped, and those people are angry and feeling pain. And we have to address that. We need a more inclusive growth, and I think that's really important. Adding insult to injury, immigration, they succeeded. It fell 42% last year to less than 600,000. The pipeline of immigrants coming into our schools has fallen, which means no more subsidies of them paying full pay and helping our kids to get some discounts on tuition. It also means the labor force of foreign-born has contracted for 6 months running in the latter part of 2019. That's the longest contraction from foreign-born that we have seen since the Great Recession. It's not going to change the demographics in terms of, it could change the labor force growth, but it doesn't change the diversity that's still coming our way. Millennials now make up the majority of the labor force, and they were, up until Gen Z, the ones behind them, the most diverse generation we'd ever produced, where women out-attain men in educational attainment. And 30% of them are what's called new minorities, Hispanics, Asians, and more than 2 races. Behind them is Gen Z, the 22 and 23-year-olds this year. Gen Z, whites are in the minority. Think about that. I told that to a CEO recently, and he said, well, they're going to be even harder to manage. Let it sit. I'm not going to say anything else. I decided not to say anything else to him. My conversation was done. It's really important that we understand these things, because at the same time that all that's going on, we're looking at wages. As Terry pointed out, they started to accelerate, then they decelerated by the end of the year. Wages for the bottom 20 to 25% of earners have accelerated since 2015, but they're now being tempered because the trickle up that once occurred is not occurring, and the middle class continues to be hollowed out. Some of the largest employers in this country, which happen to be big box retailers and online retailers, cut management pay as the pay of entry-level workers went up, or cut the number of managers, or they cut the hours worked of their workers to keep their wage bill in check. So you continue to see many of those people who are finally getting some acceleration in their wages. Remember, they were once making much more, and they've traded down on their job, and the hollowing out of the middle class continues. So I think it's really important to think about this economy in terms of, it doesn't feel as euphoric as it once did, and that's something the Fed had to come to terms with as well. Over the last year, the Fed had to eat some humble pie. They did the U-turn, as Terry mentioned, took back 3 of their rate hikes. One, because they were hedging against the weakness created by a trade war which left the manufacturing sector in a recession in 2019. Fed data last week confirmed that. The manufacturing sector is in a recession. But they offset it with finally tapping into that pent-up demand in housing, and their rate cuts have fueled the housing market. So the economy has been able to absorb that pain, but it doesn't make that pain any less real that the manufacturing sector continues to feel. We enter 2020 with a tailwind of rate cuts by the Fed and a willingness by the Fed to sustain the expansion. Not only a willingness, a commitment. The Federal Reserve now sees its role. It has more power to sustain the expansion and bring those on the sides of the marathon into the race than tools to right the ship once it capsizes. And they are committed to that because they also want a little more heat in wages. And that's something we're still missing. It's why I think the Fed will continue and cut rates again this year, at least one time. I think we're going to see the good news of the consumer continuing to perform well, but I am worried about what's continuing to go on with regard to trade. The Phase 1 China trade deal is filled with landmines and loopholes. The analysis of it is very confusing, and it doesn't lift the veil of uncertainty of trade wars when we're threatening yet another trade war in recent days against the European Union. If we do bring up the tariffs on vehicles and parts, many transplants in this country will close, and they're in red states. So I think there's a lot of political pressure not to do that, but that hasn't stopped it from happening. Tariffs on China after phase one are more than 6 times what they were on 3/4 of all imports from China. Those are taxes we pay, more than 6 times what they were before the trade wars 2 years ago. The trend has been tariffs are a goal, not a tactic. And looking at the phase one deal, they didn't get much of what they wanted, and that's disturbing to me because we do need to change the equation with China. Also, we have CEOs that are not as confident. What do they know that we don't? CEO surveys show CEO confidence is at recession levels even after the phase one deal was signed. Growth for the global economy has been ratcheted down again by the IMF. We're looking at the weakest global economy since the Great Recession in 2020. The number of CEOs who expect the global economy to slow has gone up tenfold from a year ago. What do they know that we don't? Or are they wrong? Are consumers right? Consumers are buoyant, but even there are signs of fragility. The undercurrent on consumers is their expectations about the future. Their expectations about the future, the gap between that and how they feel about the current situation has widened. It widened late in 2018, and it makes them more vulnerable to a negative news shock, which we saw. When I was standing here a year ago, we didn't have the data yet, but retail sales had actually contracted during the height of the holiday season in 2018 when wages were going up more rapidly and job gains on a monthly basis were more robust. That's highly unusual. The consumers would get so skittish that they just didn't show up. So we know we're a little more fragility in the foundations of our economy, even where confidence is high. And so that's why, again, I stay with cautious optimism. There's real economic reasons why we have the divisions we do. The kind of political environment we have is a natural outcome of economic inequality, lack of inclusion, lack of sustainability. And over the summer, I'll end my comments over the winter break. My daughter and son, as you know, I always talk about my kids. If you can imagine, our holidays are a little different than others. There's not a lot of light conversation that goes on. And my daughter is looking at graduate school now. She's got a degree in environmental and marine biology. And she said, nobody cares. And my son corrected her. And he said, no, they care. They only care about themselves. And I heard that, and I thought, my kids are the lucky ones. They don't have college debt. They have money to go to graduate school. They're the ones who got by easy. And that's the world that they see going forward. We owe it to our youth to stop making economic decisions to boost short-term economic growth and instead look at sustainability, the climate, and inclusion. I care. Thank you.
Don't you go. No, you can't leave. That was great, but I have my notes to think about. So you didn't give us a Dow prediction for next year at this time.
Because I did so lousy last year, I didn't want to do it again this year. But she never lets me off the hook on those. I am still very worried. I've got 30,500, not very much of a gain. Fed could give us a lot of the gain we saw this year was juiced by the Fed and by their balance sheet, I might add. It went back up after it went down.
Well, we're going to talk about that in the questions and answers for sure, what the Fed's doing.
Yeah, if it walks like a duck, it quacks like a duck, it's a duck. Quantitative easing. But anyways.
And seriously, I just try to make it thumbs up or thumbs down on a recession. Or percentages, odds of a recession.
So I went from 55% to 35%.
Only 35% chance of a recession.
I think that's kind of scary, but yeah.
All right. And last year you were 55% of a chance. Okay. I'm going to save this political question.
Please do.
But let me ask you, the biggest, what do you think, what is the back of your mind that you think might be the surprise of the year?
You know, there's the upside surprise would be that we finally hit a tipping point and wages accelerated on a more broad basis. They're a shadow of what they were in the 90s, and that would be a great upside surprise.
So is that inflation would be your upside surprise, or wage
Well,
inflation anyway?
you know, finally up to, the Fed's willing to, they're going to adopt an average inflation target. Yeah, inflation will pick up a little bit, but the real issue would be wage inflation, and wages, good inflation. We want
That's
wages
good.
to accelerate. Yeah, that would be the biggest upside surprise. The biggest downside surprise is that we actually get another full-blown trade war with Europe, and the geopolitical, you tell me, it seems to change on a daily basis.
Okay, thank you. And I'm going to get your stock picks later too. Okay, so just don't go away. All right. Thank you,
The only reason I
Diane.
said Disney last year is I had just been to Disney. So.
Yeah, it was a good trade. Okay, well, you know, I typically start with a bio for an introduction, but I cannot start this introduction for Dr. Bob with his bio, which I'll give you a snippet of, because in the journalism business, we would call that burying the lead, which is the key moment of the story, right? So I will go right to the key point. Last year on this stage, right after a steep market sell-off and amidst recession fears that were sweeping the nation, and with the Dow, as I previously noted, at about 24,000, and with 1/3 of our audience raising their hands to predict a market decline in 2019, Dr. Bob Freilich boldly predicted the Dow would soar over 4,000 points and break the 28,258 level. I don't know what was more startling, the bullishness or that particular exact number, and I think he's going to give you some reasoning for why he picked that number today. I'll let him explain. But lest you think that was a fluke forecast, just outrageousness, I want to remind you that Dr. Bob has made similarly outrageous, at the time, forecasts for this audience in the past few years, and they were mostly equally correct. It's a good thing I keep my notes. In 2016, Dr. Bob said, and I quote, "This is the single best time to invest in the country in the last 50 years. At that point, the Dow was 15,988. I think that's just almost half of where it is now. In 2017, Dr. Bob forecast the Dow would reach 22,222, another number that made us gasp, and why the specificity? We were then, by the way, at Dow 19,855, and the market actually soared to over 26,000 during the year. Now, he slipped a bit in 2018. I had to report that last year, done in by that year-end stock market swoon. The year ended at 24,000, but he had estimated 30,303. But of course, it got up close during the year. Which brings us to last year's outrageous 28,258. Let me slip in a bit of his bio before we introduce him. Dr. Bob brings more than 40 years of Wall Street experience. He was elected to 3 All-American institutional research teams, published, this is amazing to me, 6 investment books translated into 10 languages, and given speeches in 107 different countries. Since his retirement from Wall Street, Dr. Bob has served on the board of 15 different companies, and of course, one of our most proud accolades to you, Dr. Bob, he is the proud owner of the Kane County Cougars professional baseball team, which is the Class A affiliate of the Arizona Diamondbacks. Now, all these audiences, I have no doubt, including the baseball players, I'll bet, have heard about his important financial indexes. The Captain Underpants Index, his Baked Bean Index. You remember? I think that triggered last year's forecast, and so much more. And so much more is what we want to hear, so let me welcome to the stage Dr. Bob Freilich.
Thank you very much for that very, very kind introduction. And you don't have to be so good on the bad notes anymore. You do take notes. You're very good. Wow, it's great to be here and great to be back. I'm a firm believer that if something isn't broke, you don't try to fix it. And so I'm going to stick with sort of my same look at investing as I looked at last year, and that was don't try to find something that no one else has found, to think that you're going to find some unique investment or economic issue out there. It's impossible in this interconnected digital world to do that. So instead, if you want to be successful in investing, you need to just see what everyone else has seen, but think what no one else has thought. In other words, you have to take a different perspective of things. Look at the same thing everyone's looking at, but look at it differently. That's what I hope to share with you in the next 10, 15 minutes. 8 minutes. I'll go very fast. Look, it's as Terry said, it's the end of a decade and the beginning of a new decade. It's a very important time, I think, to take a little longer term perspective than what we typically do, although I'll still share all those forecasts. But I would urge you, I think there are 4 very important landmark trends that are right in front of us that no one's focusing on. These landmark trends are going to turn the stock market upside down. They're going to turn the economy upside down in the last 10 years. No one's talking about it. Let me share the first one with you. Bye-bye boomers. Bye-bye boomers. Diane alluded to it a little bit. The demographics of this country and the values of this country are about to change in a more dramatic measure than we've ever seen before. You see, the younger generation has different values than the older generation. You say, well, that's nothing new. That's always happened. You know, the younger generation always has different ideas, different perspectives, different values, different likes. But what's different today is the magnitude of the difference in the most basic of all the core values in this country. The Wall Street Journal did a poll 21 years ago, did it again recently. The biggest divergence in core values is between 2 demographic groups. The baby boomers and the silent generation, that would be everyone age 55 to 91, and Gen Z and the millennials. That would be everyone age 18 to 38. So that's your 2 generational differences. They ask, what are the 3 most important core values that you have? When they asked that of the baby boomers and the silent generation, those 55 to 91, they said religion, patriotism, and having children. So I'll summarize for you. That's God, country, and family. Okay? So they asked Generation Z and the millennials a little different question. What are the 3 core values that are the least important to you? The least important to you. Their answer was religion, patriotism, and having children. In other words, it was the exact same God, country, and family. We have never had a point in this country where there has been a bigger divide in the core values across generations as we have today. It speaks volumes to the political issues we're faced. It's extremely difficult to govern when you're trying to balance this diversity in core values. It's also extremely difficult to find candidates that can get elected that have to craft a message that balances those unbelievable differences in core values. But it's happening. Last year, 2019, marked the first year that the millennials are now bigger than the baby boomers. 73 million to 72 million. As the millennials team up with the generation before it, Generation Z, they are going to turn the values, the issues, and the perspective of this country upside down like you've never seen. Now, there is one bit of good news. No, not one bit. It's really very good. They do agree on something. So the baby boomers and the silent generation, those 55 and 91, and Generation Z and the millennials, those age 18 to 38, they do agree on two very important values. They both hold it very, very high to be very, very inclusive and caring of others, and community involvement, both of which we can continue to use a lot of today. But the demographic shift and the value shift is going to be a huge thing for our market and economy. The second issue is something, or trend I will call, it's the new American dream. See, I guess it isn't the old American dream, but I'd say the traditional American dream is that eventually you wanted to aspire to a life of comfort and luxury. Well, comfort and luxury implies wealth and ownership. Well, that's sort of changing now, because we have this sharing economy, and we have subscription-based services. So now, all of a sudden, you don't need as much wealth, and you may not need ownership. The old definition is being thrown out the window. I mean, think about it. You don't have to own a house or a car. I mean, now you don't even have to own a bicycle or a scooter. I mean, think about this. If you want one, just rent one. Go wherever you want, rent it, throw it down wherever you, and walk away. I mean, who would buy anything? So all of a sudden now, the need to own something is much different, which means the need to acquire wealth is no longer going to determine whether you can live a life of comfort and luxury. Now, income is still going to be important, obviously, and it's income according to banks or credit card companies, because you're going to now have to prove that you are credit worthy. But once you're credit worthy, you have access to that. Diane alluded to her in her wonderful remarks. I mean, the Generation Z and the millennials, I mean, they've lived through a very, very tough time in our economy, in our market, and many of them have given up on the American dream. They really have. They just said, we're never going to have wealth. We're never going to own things. But now, with this awesome sharing economy and this subscription-based services, they've reinvented the American dream. There is a new American dream out there. You don't need to have wealth and ownership. What you need to have is creditworthiness and non-ownership. That's the new world of comfort and luxury. And the businesses that understand that will be very, very, very successful businesses. The third trend is what I'll call the digital Iron Curtain. The digital Iron Curtain. We are in a race for supremacy in the technology sector between China and the United States. It truly is a technological Cold War. Globalization has lifted so many people to a better quality of life and quality of living, and that story is probably one of the most wonderful stories in our lifetime. But the globalization story is being fractured. It's being fractured by technology, because people around the globe, countries around the globe, are being forced to choose between United States technology standards or Chinese technology standards. Because basically, Chinese technology companies are barred from the United States, and United States technology companies are barred from China. It truly is a digital Iron Curtain. The fascinating thing is what's at stake here. People don't realize that as this rolls out and we figure out where are we going to go. Well, I mean, the three things at stake, we're talking about data collection, cybersecurity, and artificial intelligence. The winner gets to control that. There's nothing more important for any country than how this plays out. And the most ironic part of all is Europe will have more to say about who wins, probably than China or the United States. Now look, I get it. Europe has plenty of its own economic problems that they still have to deal with, but they are a huge consumer base. And the other thing, not just a huge consumer base, but they've already been extremely active in writing programs, in setting standards for technology. In fact, if you think about it, some of the privacy standards that are raising their head in the United States today are really from Europe. So it's the European movement and how they look at how we take the platform of that technology that's going to have more to say who wins and who loses in that platform than anyone else. And I know Diane alluded to the trade with China. Look, I know we've made some slight improvements, but I don't look for there to be any thawing of this war between the United States and China as far as technology is concerned. And I just think this digital Iron Curtain is something we're going to be faced with for the next decade. Fourth and final trend. Am I doing okay time-wise?
You're great.
You good? Okay. Fourth and final trend. No-mo FOMO. No-mo FOMO. I'll say it slower for you. No more FOMO. And that, you know what FOMO means, right? Fear of missing out, okay? In this unbelievable, digitally connected world we live in, where, you know, it's selfie after like, after text, after post, after whatever it has created a fear for people to be missing out. And that's what's called FOMO. And what goes along with this fear of missing out is high anxiety, they're depressed, and they're lonely. Someone sent me a picture of their steak from Gibson's, okay? Why would you do that? I'm in my pajamas eating cold cereal. Of course I'm depressed, you know? That's what we do. I mean, why did you not invite me to go to Gibson's? I would have loved to have gone, you know? So we know that this is not good for your mental health. Here's the good news. Say hello to JOMO. JOMO. No, I'm serious. It's the joy of missing out. Okay? And I'm not making this up. The University of Pennsylvania did a study. They focused on 3 things: Facebook, Snapchat, and Instagram. You know what they found out? The less you used it, the lower was your case of depression and anxiety. There really is a mental health value to put the phone down. Now, there's also business ramifications here. And the businesses that understand this will realize they have to change their business culture. And they dang well better change their scheduling if they want to be successful. Because see, the FOMOs, the fear of missing out, versus the JOMOs, the joy of missing out, boy, they are 2 different groups, okay? The fear of missing out, they want to involve with everything. They want to have an opinion on everything, and they usually get nothing done, okay? That's where they are. The JOMOs, the joy of missing out, they are just the opposite. They despise meetings. They don't want to talk to anyone that's going to get in the way. Leave me alone and let me get my job done. Okay? Very, very important from a business perspective. There is no more FOMO. So let me end where I began. Look, I get this. You know, we're always going to be worried about the short-term crisis of the day. And I know you're always going to be worried about answering your emails and your texts and your tweets and everything else. But, you know, take a longer-term view, take a longer-term perspective, the things that are really going to have an unbelievable influence on our market and on our economy is bye-bye boomers, the new American dream, the digital Iron Curtain, and no mo FOMO. I just love saying that. No mo.
We love hearing you say that. Wait, don't go away. You forgot. First of all, how did you get to 28? What was it? 858 last year.
Oh, that's well, last year it was the Chinese zodiac year of the pig.
Right. I remember that. I have that in my notes.
Well,
but
the
I
lucky
couldn't
numbers
figure
in
it
the
out.
year of the pig are 2, 5, and 8. So any combination of 2, 5, and 8, you'd have to be right. So
that wasn't in my
28,
notes.
258.
Okay.
I just figured that was like.
Okay.
Why would you not pick 28, 258?
I saw some about the pig in my notes, and
Yeah.
I couldn't.
Yes.
All right. Okay. So now, for the year ahead, what's your Dow forecast?
The Dow forecast is 33,333.
I'm speechless. You've done that to me before. Can I just say why? Why that high, and why 33333?
Well, let me tell you why that high first. I mean, I know there's so many things that could go wrong. There really are. I mean, there are too many to count. I can't even count them. But I do know that there are a couple other things. We're the world's largest producer of oil. We're the world's largest producer of natural gas. We're the world's largest producer of coal, or second. We have lowest unemployment in, 50 years, and corporations are flush with cash. So as I struggle with where the market's going, I'm saying, well, wait a minute. So we got all the oil, all the natural gas, all the coal, all the jobs, and all the money. I mean, I don't know. I just think it's a good, I just think it's good. I mean, I could be wrong, but
Wait, let me get back to my chart. What's the implication for interest rates on the 10-year Treasury? We're like at, 271, or 171, I'm sorry.
Why would you ask me that? Do you know who's sitting next to you? Jeffrey's coming up. He's the bond king, for goodness sakes. There's a bond hall of fame, and he's in it. I don't even care what I think about it. I want to hear. I want to hear what he has to say.
But wait, does this push interest rates up? There's a supply of money, so maybe it doesn't. But there's economic growth, so maybe there's a demand. So what happens to interest rates this year?
If I were forecasting off. Jeffrey, give me one of these. 10-year round two, what would you think? 2 or? Little above, a little above 2, we're thinking.
No colluding.
Little above 2, probably.
A little 2 plus, okay. And if there were a surprise this year, will there be a recession? Obviously, no. I mean, I can't even ask that.
Can I do negative numbers? Negative
Sure.
10.
Negative 10% chance. Negative 10% chance of recession. Okay.
Try to measure me on that one, by the way. I can't wait.
I was never good at math. How about, what kind of a surprise do you think might happen? I'm coming to politics later.
No.
Oh, you've got a surprise?
Oh, no, it's big. The surprise is big. Garbage.
What?
Garbage. It's the garbage indicator. It's one of the most important economic indicators out there.
Sorry, I missed it.
It's a weekly report. The American Association of Railroads issues a report every week. And probably the strongest correlation, not probably the strongest, is over 80% between the economic growth and is with trash. And it's not traditional trash as we think of. The bulk of trash that's going in railroad cars is steel, is iron ore, it's trash from demolition, but there is municipal trash in there as well. I think 2020, you're going to see a record year in trash, which means good year for the economy, good year for the market. So, watch the garbage indicator. That's it. That's the one.
Well, one thing, we don't have any garbage up here. Thank you very much, Dr. Bob.
Oh,
Yeah?
Oh, I'm sorry, you can come up.
Go ahead. No, go ahead.
No, I did.
won't
I'm
leave
sorry.
anything
No,
unsaid.
I had one more thing.
Okay.
I'm really not sure that you all in the audience really appreciate what 40 years means. People in our industry get bored after 40 minutes, and Terry has been involved for 40 years putting this panel together, bringing people. The gentleman you're about to hear from is a legend unto himself, and she brings these people together here. I think this audience owes her a debt of gratitude, this executive club and the whole city. And
You're over time. You're over time.
And we owe her a standing ovation. So I would please ask you to stand. Everyone.
Thank you. But you still won't get more time next year. God willing, we'll all be back here next year. Thank you all. That's very much appreciated. Okay, let me move on. So the real challenge every year is to get the person foremost in the issues that face the day. And this year is absolutely, we've had some spectacular wild cards, I call them, over the years, but this is really the most exciting to me. I'm so glad that Geoffrey Gundlach agreed to be here today. He's the CEO of Double Line Capital, an investment firm and investment advisor with $150 billion in assets under management. I'll let you think about that number. He started it 10 years ago. But that's not the extent, the size of the AUM of Jeff Gundlach's investment influence over the markets. He is really today's most widely quoted investment superstar. When he appears on CNBC, the tape slows to a crawl because everybody's looking up at the CNBC monitors on the floor or on their desks around the world, waiting to see what he has to say. They don't want to miss a word. In 2011, he appeared on the cover of Barron's with a headline calling him the new Bond King. In 2013, Institutional Investor named him Money Manager of the Year. He's ubiquitous on Bloomberg's 50 most influential list of market participants, and in 2017, he was inducted into the Fixed Income Hall of Fame. Since starting DoubleLine a decade ago, its performance has been nothing short of spectacular. The firm's total return bond fund is up 5.9% a year on average since its 2010 launch, outpacing its benchmark 3.8% annualized gain. Remember, that's a bond fund in a decade where interest rates have hovered at record low levels. And when it comes to equities, the DoubleLine Schiller Enhanced Cape Fund has risen 15% a year since it opened in late 2013, beating the S&P 500 index 12% increase. And by the way, who says stock picking is dead? For months, Jeff has been warning about the bond market, specifically about the leverage taken on by U.S. corporations and the unrealistically favorable ratings that some debt has been given. I'm sure we'll hear more about that today, and how that will impact the stock market. And in the bond market, for sure, I'm going to ask you this question myself about the repo squeeze last fall and the Fed's actions in creating liquidity. I would also like to remind you, and thus I'm going to ask all the panelists this for sure, that Jeff Gundlach was one of the very first to predict that Donald Trump would become president way, way, way back. So for sure, we will ask how this election year might impact the markets. Let's get started. Please welcome DoubleLine CEO Jeff Gundlach.
Well, thank you. It's a pleasure to be here. I was not even aware of this event's existence when I was invited to come, and I didn't really know what to expect, but I certainly was impressed by the first two speakers. Diane and Dr. Bob both spoke about kind of the momentous juncture in history that we are kind of moving towards or find ourselves at. I would add two things to that, which are, mean to be helpful in thinking about historical change. One of them is, and it's strange to say this name in a room with this type of event and audience, one of them is the philosophy of Karl Marx, who has gotten a bad rap as being like a communist. But Karl Marx actually said when his work was perverted by the cultish communists, he said, if this is communism, then I'm not a communist. What he really was a political philosopher, and he observed how revolutions occur. And the way it begins is society begins in a really happy place where everything is divided up in a way that works for people. So you have the property relations, or how things are divvied up, and then you've got the means of production, which is how things are created. And stretches of time go on without a lot of innovation. And then something happens, like the telegraph, or the railroad, or the steam engine, or the radio, or the TV, or the internet, and social media. And Dr. Bob was talking about depression is linked to Instagram. I wonder what's the cause and what's the effect? Is it the Instagram that makes you depressed, or if it's you're depressed and so you go to Instagram? I'm not sure. But these things get out of whack when there's massive innovation, which obviously happened with the internet and social media. And what ends up happening is the property relations are not easy to change. The means of production can change in a revolutionary way, but the property relations get ossified, because of course the people that benefit from the property relations, they have power and they have wealth, and they don't want them to change. So not only are they slow to change because they're evolutionary and not revolutionary, but there's tremendous resistance to changing them. And then things get so out of whack between the property relations, and wealth inequality is part of how that manifests itself. and the means of production that something snaps, and you have either a violent physical revolution or you have to start all over again through new property relations. Well, there's another theory of this, which goes kind of the same way, and this is a book I'm going to recommend to you. It's called The Fourth Turning, and it's by the #1 demographer in the United States, whose name is Neil Howe, Howe, and he talks about this in a different context, but it's largely the same message. It's you start out with institutions that everybody buys into and everybody is gung-ho about, and that's the first turning. And then through degrees, you get to what's called the fourth turning, which means that there is now a ossification of those institutions, and it's no longer working for the evolving society. A lot of parallels here between Karl Marx and the fourth turning, and ultimately the fourth turning leads to the only solution, which is to destroy the institutions and start over again. And these happen with some regularity. I don't want to be doom and gloomy about this because it doesn't have to be this way, but the last two fourth turnings preceded the Civil War in the United States and World War II. And if you don't see that we're in a fourth turning, you're not paying attention to the political environment and other things. So I wanted to go back to those points that Diane and Dr. Bob brought up, because I think they are extremely important. And one of the things that's manifesting itself with this, and this was brought up earlier too, is the national debt-based growth of the United States economy. During the year 2018, and it was a little smaller in 2019, but we grew the national debt by, and I'm not talking about the deficit, I'm talking about the real thing, the national debt. The deficit is a lie. They don't tell you the real amount of borrowing in the deficit because there's a lot of off-balance sheet items. But the national debt in the year 2018 grew by over 6% of GDP. Nominal GDP, which is smaller than the national debt, grew by about 5%, 5 point something percent. So the national debt, which is bigger in dollars, grew more dollars than the entire nominal GDP of the United States, which means if you hadn't grown the national debt in 2018, the economy would have been negative. And so we have a debt-based economic scheme which is completely unsustainable, and as was pointed out earlier as well, this is during what's perceived to be the greatest economy in the universe and other such hyperbole, which is, of course, is total nonsense. The economy is growing far less than it did 2 years ago, just for starters. 2017 and 2018 were better economies than we have right now. So we have a debt-based economic scheme. So how are we going to get out of this? Well, it's going to be really something to see in the next recession. It's true that I predicted in the first week of January of 2016, before the first primary or caucus, that Donald Trump would be the next president of the United States. And I also added to that prediction, which didn't get reported in the media, if you think the 2016 election is weird, you ain't seen nothing yet. Because this 2021, and we'll talk about this later, is going to be pretty interesting. Now, it's true that the Dow Jones Industrial Average and the S&P 500 and the NASDAQ are at new highs, but it's not true that all the stock indices are at new highs. The transport index is nowhere near new highs. The New York Exchange Stock Exchange Composite's not at new highs, and some small cap indices are lagging as well. But it's certainly been a very strong market thanks to the Fed. There's just no doubt about it. The Fed was torturing the market in the fourth quarter of 2018 with really out of sync with the market ideas, rhetoric about more rate hikes and quantitative tightening and the like. But they really got religion in a hurry when we put in a 20% plus decline in the major averages in the United States. But the Fed thing is really interesting because counterintuitively, when the Fed is pumping money into the system through quantitative easing 1, 2, and 3, and now this repo facility thing that they're loath to call quantitative easing, most people think that when they're doing that, you should get interest rates falling. But the opposite has happened every single time. When the Fed starts doing QE, weirdly, the interest rates go up on the long end, the yield curve steepens, and the dollar actually starts to go down. It's very strange because it's kind of counterintuitive how it works. The 10-year Treasury has been very stable in terms of its yield. There was some discussion about that. I have two indicators for the 10-year Treasury, which I will share with you free of charge, and these are very valuable. So it's a funny thing to give free stuff away, but I don't mind helping people. So one way to think of where the 10-year Treasury should be, and it is a remarkable short-term indicator, it's really just almost unbelievable how well it works, is the price of copper divided by the price of gold. And if you follow that over the short term and intermediate term, it's incredible how it tracks the 10-year Treasury. Right now, that ratio says the 10-year Treasury should be at 1.80%, and it's at 1.78%. So not much of a signal there, but there are times, like in the fourth quarter of 2018 in December, when there's a divergence that develops over a few weeks. And what happened in December of 2018 was the copper-gold ratio was dropping like a stone, and the 10-year Treasury was maintaining above 3%. And we know what happened from the chart that Terry showed, that we had a 100 basis point drop over the last 12 months in the 10-year, and it was presaged by the copper-gold ratio. There's no signal now. It just basically says it's where it's supposed to be. Longer term, one of the best indicators of where the 10-year Treasury should be is to have, and this works incredibly well for a several quarter forward time period, and it's worked for 30 years. Only during recessions does this following indicator not work perfectly, just about. And that is take year-over-year nominal GDP in the United States and average it with the yield on the German 10-year Bund. Now, it used to be you just use nominal GDP in the United States because US rates and German rates tracked very closely together. But in the aftermath of the global financial crisis, there's been a big divergence where the US has nearly a 2% 10-year and Germany is now negative 25 basis points. One of the logic you have on this is that we have the GDP in the United States, which is up at 4.5% or so nominally, that's pulling our 10-year higher because economic growth creates pressure upward on interest rates, but it's being dragged lower by desperation of investors in Europe, and I would also add Japan, who are struggling with negative interest rates in their financial systems, which is a horrible situation if you're a bank or an insurance company. One thing I'd like to point out is that if we start in 1995 and you track the bank stocks in Japan, in the Eurozone, the United States, using major bank indices, it's remarkable that since 1995, the Japanese banking system has done nothing but go down, and its bank index is actually down 80% in price from 1995. Why is that? I believe it's because the Bank of Japan went to negative interest rates first, and that was fatal to its banking system. Then we had the United States and Europe go up tremendously in price in their banking sectors from 1995 until 2006 and 7. They went up in lockstep together. Since that joined peak of around 2007, the US banking sector has made it all the way back to near its high of 2007. So it went way down in the global financial crisis, and it's rebounded that index all the way back up. The European bank index is down 15% from 1995, let alone that peak in 2007. It's down over the past 25 years. And we see that the United States has made it back. Why is that? Well, it's because Europe has been living with negative interest rates, which are really fatal to their banking system. So it'll be interesting to see what's going to happen in the United States in the next recession, because Jay Powell, I don't like Jay Powell's U-turn. I like to have more confidence in a steady hand on the tiller. But one thing I do like about Jay Powell, and I applaud him loudly for this, is he has rejected the idea, at least for now, of going to negative interest rates in the next recession. Hallelujah. Because if the Fed goes to negative interest rates in the next recession, there will be an implosion of the entire global financial system because there's nowhere for capital to go. Japan is in purgatory, Europe is in purgatory, but at least their banks and insurance companies can find a place for capital somewhere that can take a lot of capital. That's the United States. If the US were to go to negative interest rates, there'd be nowhere for capital to go, and there would be complete capital destruction. So that's a good thing that we're not talking about negative interest rates. What we're talking about is large-scale asset purchases, which is something we all become used to. And one thing that's been pretty clear over the last multiple years is that risk assets in the United States love quantitative easing, and they love liquidity being pumped into the system. And the fact that M2 growth is running at a high level doesn't really matter in the way that it used to, because the economy doesn't need the money. It's the financial sector the financial markets that benefit from that. But one thing that Jay Powell said that didn't get nearly enough play was in late October of last year, and I'm paraphrasing. It was at the press conference at the Fed meeting at the end of October. He said, we would need to see a substantial rise in inflation that is persistent for us to even think about raising interest rates to cut inflation. This is the Fed telling you that they want the interest rates to be forever below the inflation rate and forever below the nominal growth of the economy, and you can't blame them because we have 23 and change trillion dollars of national debt right now and about 600% of GDP in total unfunded liabilities in the United States. So at least you can slow down that compounding curve. Now, the last comment I'm going to make, and then we'll move into the next segment, I guess, or Terry will probably pepper me with some questions. I think one of the biggest themes that I believe in is that the US dollar is going to be headed lower in the multiple years ahead. The dollar moves in very predictable 8-year-ish cycles, and it tends to go up with very little interruption when it's in a strong cycle, and then down with very little interruption when it's weak. And the dollar peaked 3 years ago in January of 2017, and the Dixie index was at 103 and change, and now it's at 97. So it hasn't weakened very much. But two things are highly, highly correlated to a weak dollar versus a basket of foreign currencies. One is when the Fed starts easing, the dollar tends to fall, particularly if they're easing at a pace in excess of other central banks. And given the way the starting point, it's very unlikely that Europe can really cut rates anymore, and the Fed has cut 3 times and may cut again. Another thing that's very highly correlated to a weak dollar is the twin deficits in the United States, the budget deficit and the trade deficit. In spite of the trade war that was supposed to shrink our trade deficit, the trade deficit with the rest of the world has not gone down. It's actually gone up under President Trump, not at a high rate, but it has been going up. One comment on the trade war, the trade deal, the phase 1 trade deal is cosmetic. It doesn't mean anything. It was purely to say that I kind of put together one of my promises, and there will absolutely positively be no further trade deal before the election because there's no incentive for China to do it. But our budget deficit continues to grow, and so the twin deficits are rising, and the correlation is extremely high. And in fact, if you do a lead on the twin deficits and the value of a dollar against a basket, it has about a 20-month lead or a 24-month lead, and it's right now at the point where it should be falling. So that leads me to be favorable on assets that are weak dollar oriented. And that my favorite asset in that regard on a relative basis would be emerging market equity versus US equity. One of the things that we like to use are value measures in equities. The CAPE ratio, Dr. Schiller's CAPE ratio of the emerging markets is half of the level of the S&P 500. And you might think, well, that's normal. You know, US is the powerhouse, emerging markets are basket cases, so it makes sense that there should be this discount in the valuation of the CAPE ratio for emerging markets versus the US. That sounds intuitive, but it's wrong, because there have been multiple instances over the last 25 years that the CAPE ratio in the emerging markets was higher than the CAPE ratio of the United States. So think about simplistically, that means emerging markets could outperform by 100%. But for things to really move significantly, I think, in the market, for volatility to come in, you really would need a recession. And right now, I have many recession indicators. I would put together a similar recession probability as Diane. I'm at about 30%. I think the consensus is around 30, so I don't have much information there. But the two things to watch that are keeping things together, one is consumer confidence that Terry had on the screen, and she showed how high it is. If you looked at that screen that screen chart with a jaundiced eye, you might have noticed that it's often at this type of level 6 months before a recession. It starts tanking before the recession comes. That hasn't happened yet. However, another indicator, which was alluded to, and it's absolutely a good one to use, is to notice how consumers are thinking about the future and compare it to how they think about today. Right now, consumers are thinking today is pretty good, and we saw that in Terry's chart. However, they decided about a year and a half ago that the future looked terrible. And the view of the future has been lousy that whole time. And this is fairly typical. So what ends up happening is their view of today is fine, and that keeps spending going along, but they're worried about the future, and then something happens, some sort of an event, and they start to lose confidence in the present. And you start to see the gap between the view of the future and the view of the present start to narrow, with the present coming down. And that is fatal. That's a recession almost definitionally. They say, uh-oh, that future that I feared is now upon us. So that's an indicator you have to watch, and that ties in completely understandably to employment or unemployment. Every week there are unemployment claims that are released, the weekly unemployment claims. And the one thing that Trump can say truthfully, he can't say he's created tons of jobs. The monthly jobs are actually a little lower than the last 3 years of Obama. The first 3 years of Trump, the job creation is actually lower than the last 3 years of Obama, using the first Friday of every month report. But one thing Trump can say truthfully is unemployment claims have really gone down. They've gone down by about 50% from when he took office every week. So they're down there at the low 200,000s. It's unlikely that they'll fall any further because there's sort of a floor, I think, at this type of a level. But if you run the 5-year moving average of these weekly unemployment claims, and you just take every week's result, we actually smoothed it out using the 4-week moving average. But if it crosses above the 5-year moving average, you're dead. You're in a recession, because that starts the whole domino chain going. When people start to realize that layoffs are starting to happen, then their view of the present starts to deteriorate, and it's almost definition of a recession. Right now, that moving average, that 60-month moving average, 5-year moving average, is at about 240,000. And the most recent prints on the weekly data have been down at around 215,000. So there's a little bit of a cushion there. We got about a 25,000 cushion, but that's, you got to watch. If we go above 240,000 on weekly unemployment claims, I think your probability of recession goes up towards 80, 90, 100%. And so that's what we're looking for. I look for the 10-year Treasury. Dr. Bob looked at me. I look for that to have a U-turn. I think that with the Fed doing quantitative easing and looking for inflation, the path of least resistance for long-term interest rates should be higher. But as we saw in 2018, not much higher interest rates have cratered the stock market, and it seems it takes lesser and lesser of an interest rate rise to cause turmoil in financial markets. Jay Powell has told us that when something goes wrong with probably the market, because he seems to look at that a lot, or the economy, and those may be interrelated at times, he's told us that he plans on fighting it with large-scale asset purchases, which means manipulated interest rates. So I'm looking for interest rates under an organic world. If the Fed wasn't involved, which of course they are, if the Fed wasn't involved, I think interest rates would be 200 basis points higher than they are right now on the long end. But they won't let that happen. So as an investor, it's a very tricky situation, because I think right now you're supposed to be looking for higher rates, but the Fed won't let them go much higher. And so you might get a buying opportunity that's related to the Fed going back into manipulation mode. So I think that's kind of some of the points I wanted to cover. And Terry?
You just forgot the Dow.
The Dow, I'm going to say, end of the year, I'm going to say 28,200. I think we're in the world right now. I even got an economic note today from someone I respect a lot, but he's kind of a permabull. He's always looking for reasons that the glass is fully full. And the one he gave me today was synchronized global expansion, that there's evidence. And there actually is evidence of that. Even the South Korean stock market, which is highly export sensitive, has really gone up sharply in the last couple of months. It's doing very, very well. But synchronized global expansion was very much the theme that you couldn't stop hearing if you were listening to financial media, January 26th of 2018, which was the high of the global stock market that day. So one thing about the market is it's a discounting mechanism. So there was a great market newsletter writer named Joe Granville, who passed away a couple decades ago probably now, and he said, what's obvious is obviously wrong. And I changed that to what's obvious is obviously priced in. And so something like synchronized global expansion being in the air is not really that bullish. So I'm looking for probably some further gains in the stock market, but then to be followed by coming back down to slightly lower than we are today.
Okay, well, we couldn't ask for more. Thank you very much.
Thank you.
Can I ask the panel? Yeah. And let me ask the panelists, right, to come up and assume your usual positions. Okay. Well, wow. So let me see what I just heard. I heard Dr. Bob is bullish for generational reasons and also for the market ahead. Diane is moderately positive and not too concerned about a recession. And Jeff is concerned about, I think primarily, wouldn't it be the Fed? Because damned if they do and damned if they don't. Is that what I heard?
Yeah, the Fed.
Have you get the mics all up, please? Yeah, thanks.
Yeah, the Fed is really in a bad spot because they really can't get out of this quantitative easing. I mean, when Ben Bernanke started quantitative easing, he said it was temporary, and once things got on their feet again, it would be completely removed. Instead, we had to do 2 more rounds of it, and we got to $4.5 trillion on the Fed's balance sheet. And they tried to get back down to $3.5 trillion. They got part of the way there, and the market went berserk. Yep. And there were 42 days in a row where there was an inability to float a single junk bond issuance. The market was closed for basically 2 months of trading. So now they're back with the repo facility thing, and it's disconcerting that the Fed doesn't seem to know what the definition of temporary is. They've said that this is a temporary repo facility increase, but it started September 17th, and that was 4 months ago. So I think one of the biggest risks for investor psychology is that the Fed doesn't seem to have a solution to what they've called a temporary problem, but it seems to have evolved into a permanent problem.
Diane, you always talk to the Fed.
Yeah,
Do you think that in their secret meetings they're going, oh my God, what do we do now? Nothing works.
They would never admit that.
No, I didn't think they'd. Maybe to you they'd admit it.
No, it is one of the issues. This is also a side effect that everyone says deficits don't matter anymore, and they do. And one of the side effects of issuing all the debt that we just issued, particularly in September, was some of the distortions in the market as well. And I don't think the Fed has a full grasp of why. And they've now talked about keeping I said it walks like a duck, it quacks like a duck, it's a duck, it's quantitative easing, keeping that in place through at least April, tax season, which
Wait, they get money in April. Why would they need to keep easing in April?
They have to pay taxes in April, but companies do, corporations.
Yeah, that's what I mean. So money's coming in. Oh, so the institutions
No,
need
the
the money.
institutions need the money.
There's demand for money.
Yeah, and one of the things is, you can't, it was interesting is when Jay Powell was asked about the repo situation, that's when he looked at his notes on the last press conference. Because he doesn't really know, and
right.
they don't really know.
I had one of the funniest meetings of my life where I had an institutional account I was managing money for, and they had a funny format where all the managers were at the table together, and they spoke sequentially. So the board listened to all the managers heard the managers. One of the managers had really bad performance, and the board wanted to ask about it. And he said, well, what went wrong? I mean, what happened in this performance? And the fellow from this money management firm actually said to the board, it's funny. We're just as confused as you are. We have no idea what happened. And of course, they got fired on the spot. Right? It was the most amazing thing. But that's the Fed. Like, what happened to the repo market? We're just as confused as you are. We have no idea. They're blaming it on September 15th tax payments, and they're blaming it on a mismatch of T-bills maturing versus those being issued.
So much bigger.
What, you didn't know that?
Well,
you don't know that there's tax payments? You don't know what the maturity schedule is of the Treasury Department? So what they didn't know is what the liquidity needs were. They underestimated the reserve needs. And my problem with this is at that moment, the yield curve, the highest yield on the yield curve was basically T-bills.
Yeah.
So here you had a situation with very low interest rates. The 10-year Treasury was like at 180 or something. Overnight money was at 2.25. I don't know, is it just me, or would I prefer 2.25 overnight to 180, 10 years when you have an inflation rate that's 2.3? I mean, who wants to lock in a negative 50 basis point for 10 years? What I'm saying is the most attractive part of the curve wouldn't clear at the Fed funds rate. That's pretty scary, and it leads me to believe, again, organically, in the next recession, when we have a $4 trillion budget deficit, because we will in the next recession, long rates would be skyrocketing if they were left to market clearing devices, but they're not going to let it happen.
Well, I would go one step further. The Fed is not allowing price discovery either in the
Right.
repo market.
You know,
And
why
that-
is it that we manipulate interest rates and don't manipulate the price of an apple?
Well, there are subsidies.
Yes, true. Okay,
I mean, come on, farm
pencils,
subsidies,
pencils,
agricultural subsidies, those are the ones that-
pencils, money
Wait
management
a second.
fees.
This is getting very depressing. I think what I'm just hearing. Wait. I got to see if I'm hearing this
and
right.
I like, they're
You're-
my friends. I like
All
them.
right, okay. So you're saying that obviously we're running $1 trillion budget deficits annually in good times, so it's going to be worse. There's going to be a lot of debt to roll over, a lot of new debt to finance. Ordinarily, that would push interest rates up, but the Fed's going to buy all that debt, put new money into the economy. Did I hear the word inflation, or does that not count anymore?
Yeah, I think the way the inflation comes is through expansion of free money, giving away money. It's funny that a few years ago, people talked about helicopter money. Ben Bernanke
Yeah.
even said
Yeah.
so. And they now, Andrew Yang and universal basic income. 10 years ago, people thought that was heresy. You mentioned like government giving money to everybody. That was like insane. But what people don't understand is we've been doing that on a limited basis for 50 years. Welfare, Social
Yeah,
Security,
yeah.
we've been doing it for a long time.
They don't know that's
And in the
entitled.
next recession, I think the pressure will be very high to have further giveaways. If people say you can't get inflation, yes, you can. You can't get it through quantitative easing. That seems clear. At least
Right,
you
'cause
get,
we'd
you get
have it.
stocks. You have inflation in real estate, inflation in stocks,
is
inflation in
asset
Bitcoin,
prices.
inflation in a little bit in gold now. But if you want to get inflation, I can guarantee you, I can get inflation by 5 o'clock this afternoon. I can. The secretary, the government, the Treasury Secretary and the Fed, they all agree, we are going to give every American $1 billion.
They would do it.
$1 billion, and it's going to happen at 3 p.m. today. Well, if you don't get inflation by 5 p.m., the lines of the
They're
Ferrari
dead.
dealers would be really something to
Yeah,
see,
see.
right? So
No, they'd be sharing the.
That reminds me of playing Monopoly in my family. My brother always said, "This game's going too slow. I'm going to give everybody another $100 bill." That's how I learned about
when I was
inflation.
4 years old, this is the truth. I'm going to beat Joe Biden for a second. Not a joke. Not a joke. The fact of the matter is that when I was 4 years old, I said to my mother, "Mom, I got this great idea. We could make everybody not poor. We could give everybody $1 million." I actually said that to my mother. And my mother's like, "Oh, just think, an apple would cost $100. And I was 4 years old. And I said, "You know what? I kind of get that. You're right."
We need to
Right.
teach our children better. They think socialism is a real good thing. Dr. Bob, the world is falling apart according to the two people on my left. We're going to have debt. I mean, it can't last forever. There'll be a recession. There'll be deficits. The Fed will finance them. Assets may crash because the dollar, nobody believes in the dollar anymore because, you know, the Fed buying all that debt and paying for it with new money is a lot like my brother in the Monopoly game, or you with $1 billion, or Andrew Yang maybe. So the question is, are you still optimistic down there, Dr. Bob?
I am. Not without its downsides. I mean, there are downsides, but I look at this economy, and it's driven 2/3 by the consumer, and consumers have jobs. Many of them have better paying jobs than they had a couple years ago. I mean, I know we focus on the consumer confidence number. It's really critical, and so I think corporations do have the flexibility with cash on their balance sheets. I like what I see in the employment market. I like what I see with the consumers when you go to the mall and the shopping that's there. I mean, it's not that it isn't fragile, but I think the fundamentals are there. I mean, I think the underlying employment market is see, I'm not an economist, so I don't, the way it's measured sometimes confuses me, like if you're not looking for a job, all of a sudden you're not employed. Well, but I can tell you, I've owned a business now for 6 years. And so for the first 5 years at the King County Cougars, we had a 25-person front office staff that stayed that way. Last year, 10 of them got a new job that paid them more money, okay? For the first 5 years, I have a part-time staff of 500 employees. For the first 5 years, that's all I needed. Last year, I had to hire 750 people because 250 of the 500 left during the season, whether they were food and beverage people, whether they were maintenance people, parking people. So, I mean, there is so much movement within the employment market. It's unbelievable, and especially as a business owner trying to get someone to do a smaller job. If you have a big job, it's easy. So to me, you know, I like it when contractors don't call me back because they have other things going on. So I
As an
I just
economist,
think,
all right. So who blows the whistle, rings the bell, or what is it that punctures the balloon, what term you want to use, that all of a sudden, all this great demand for labor, things are going well, consumer confidence, et cetera, et cetera. Jeff, you said you'll see it in the new claims, but is there a thing that will happen that will that you think of that will
What
do
we
that?
worried about last year, and we flirted with recession, and what we worried about was the trade war would get to a tipping point and spread into the service sector. And the last round of tariffs did go into retail, but they were rolled back a bit and didn't go fully into the service sector. So that helped to contain. But we have a recession in the manufacturing sector right now, and that's a reality.
Sure.
And we've got, something's got to give. Either CEOs have got to start feeling a little more confident and willing to place at least some bets on the economy. And I agree with Geoffrey on the phase one deal does not lift the veil of uncertainty for CEOs. They're still in recession territory on their confidence, and they're expecting a worse year in the global economy this year. So they're seeing something that we're not. So something's got to give. Either they've got to get more confident and start investing in our future again. We actually saw investment contract last year.
As opposed to buying back stock, maybe?
Exactly, as opposed to just buying back stock and also just going into debt. I know Geoffrey has a lot, I'm worried about corporate debt as well.
Yeah.
But on the other side of it, we're going to see the confidence impinge on hiring as well. And we have seen things like job openings have fallen not only on a year-over-year basis, but also on a month-to-month basis in the last 6 months of the year. The JOLTS data, the quit rate, which is your best indicator of future wage acceleration, has fallen and then plateaued. Now, we'd like to see it move back up again. It's not that this hasn't happened before. And, it's great that you can't find workers, but if you read the Beige Book, what was the biggest problem in 2012 that employers reported? There's no workers. In 2012, when the unemployment rate was much higher and wages were not going up. And wages have decelerated again because of the unevenness, and we're still hollowing out the middle class. Yes, they're getting paid more. People who switch jobs are getting paid more. But millennials, believe it or not, they don't switch jobs as much as we did. And I think that's really important too. They get a bad rap.
Let me change this, because you mentioned debt, and before, we've got a lot of great questions here. All right,
Corporate debt is really
let me just go back before we leave the financial market section of this. Corporate debt, there are a couple of questions here on corporate debt, and does the level of debt concern you? And the rating, and one was about the ratings of corporate debt. Jeff, you're the bond king.
Yeah, the growth in corporate debt has really been astonishing. Since 2007, it's basically doubled in size. And the investment grade corporate bond market in particular. The high yield market's been fairly stable, really. A lot of it's been refinanced into bank loans, and there's been some upgrades. But I think that there is a lot of leverage in the corporate economy. Corporate debt as a percentage of GDP is basically at an all-time high, and the types of levels that were seen before the past two major recessions. And from where I sit, and I sit pretty close to this stuff, the BBB corporate bond market, which is 53% of the investment grade market, a lot of it doesn't deserve to be triple B rather, in my opinion. And so you have a real issue that you could have en masse downgrades of BBB. Everything that I say, I keep following with the same qualifier, in the next recession. The next recession is going to unleash a lot of problems because the corporate debt problem will be revealed, just like the securitized and mortgage problem got revealed, but only when the recession came.
So that's where it's going to show up first.
yeah, and I think
in a crisis
and
kind
I
of
think
mode.
there will be
And it'll make the recession
massive
worse.
selling
All right.
of
Now,
corporate bonds by foreigners who've been, particularly Japanese, have been huge buyers of corporate bonds because they're desperate. They're desperate to escape negative yields in their country, and they do it without hedging back into the yen, because if they hedge back into the yen,
They don't get
get anything. Everything gets eliminated. So what they've done is buy corporate bonds out of need, which is the most dangerous thing, because when people don't even like what they're buying, but they're buying because they sort of have to, they get really uncomfortable
So
when
they
it
can
starts
get
to
the
fall.
yield.
They get really uncomfortable when it starts to
And
fall.
then what does it look
and
like?
the dollar will be falling.
oh yeah.
And so they'll be having the dollar falling and the bond prices falling, which will lead to that kind of a waterfall problem.
Could you please promise to come back that year?
Yeah, well, who knows
Please
when it'll
try.
be?
Okay. Now, I want to move on to politics because our time is running short. And if I get a few more of your questions in on sustainability and so forth, I will. But, Jeff, I'm going to start with you because you were the earlier predictor when it was a joke
Yeah.
that Trump would be president. I mean,
Yeah.
at the very, very, very beginning.
Yeah,
So
I never
who
gave
will
up
be
on
the
that.
candidates?
Well,
do you
obviously,
think?
obviously Trump, and the question is, again, it's all recession focused. Without a recession, I just don't see any of these Democratic candidates having a chance. I mean, I'm kind of astounded and worried by the durability of Joe Biden, who just can't even finish a sentence. It's just unbelievable to read,
been a good
just to read the transcripts of the stuff, and it's much worse when we even hear it. So I just think that he's polling exactly where it was a year ago, when he wasn't even in the race. He had his moment in the sun, and he's getting a little stronger now because I think Elizabeth Warren has completely cratered. She's down for the count. I mean, she had a little shtick going there where she had it together with her little sweaters and, you know, I've got a plan for that and all that stuff, and then it turned out all the plans were half-baked. And it was really revealed on the universal health care, which she just completely choked on.
Yeah.
And she's done. I've got this new theory that basically I think you could have a brokered convention in the Democratic situation. I think Bernie is kind of fundamentally the strongest candidate. It's so ironic with all your comments, Bob, about the generational stuff. It's so true. It's so odd that with this difference in core values, Bernie's supporters are all millennials and Gen Zs. It's so weird. And Biden seems to be trying as hard as he can to get nobody under the age of 55 to vote for him. He's trying really hard. So I just can't take Biden seriously. And so
Well, who do you think will
that
be the
leaves me with
Democratic
That leaves me
nominee?
with Bernie.
Bernie?
But the thing that's the wild card here is Bloomberg. Not that he's electable.
I'm glad you said that.
He's not electable. But he can fund Biden.
Yeah.
Because Biden can't raise any money. Because who here enthusiastically supports Joe Biden? Who here knows somebody anybody? I mean, there's nobody. So he can't raise any money. But Bloomberg, he has no chance. I mean, buying Super Bowl ads and stuff. I mean, I think these New York mayors are really delusional. Like de Blasio, they actually think the world just revolves around New York, and everybody secretly wants to be a New Yorker and talk with a Brooklyn accent and all this stuff. And yet, right? And yet de Blasio, he got 0 votes. And now Bloomberg doesn't realize that being mayor of New York is not really going to be a great selling point in flyover country. It just isn't. And, but Bloomberg
Would he
could
ever
fund
throw his
Biden.
support to Biden? In
He
your
doesn't have any
wildest
support.
dreams?
He doesn't have any support. He's got money.
Or money? I mean, do you think?
Yeah, I mean, I could
right.
actually see some sort of a weird deal where Bloomberg ends up on a VP slate. Bernie should win it. He'll steal it from him again. But maybe Biden gets propped up with Bloomberg's money, and there'll be a huge fight at the convention because the Bernie supporters really will be mad if he gets ripped off again. It's like the
All right.
New Orleans Saints fans.
Dr.
They
Bob,
got screwed
real
twice.
Dr. Bob, tell me one thing. Who do you think the candidates will be, and who? I'm not asking who you like, but how do you assess the candidate likelihood?
I think Geoffrey did an excellent job, sort of framing. I mean, obviously, Trump on the Republican side. But I still think it's a three-person race yet on the Democratic side between Sanders and Elizabeth Warren and Joe Biden. I don't see Bloomberg as a viable candidate, but within that, I just think it is going to be a very contentious, convention.
Interesting
But
summer.
I think Biden is going to come out with the Democratic nomination. So I
You
think
think
it's
so?
going to
Okay.
be Biden against Trump, and then I think that actually, I'm sorry, not Biden. I actually think. I'm sorry, I misspoke. Bernie Sanders. I think Sanders is going to come out, so it'll be
All right.
Sanders and Trump. And I actually think that Sanders will actually win the popular vote and lose
here
the
we go again.
and lose the presidential election.
Okay.
It's happened-
Diane,
I really-
it's
you
happened
said you
twice.
didn't want to, you
I
don't
really
want to
do.
jump
No,
in?
I'm just saying. I think he will win if he gets the nomination. I actually think that the way the electoral college is, that he will have enough popular votes to be president, but he will not carry the electoral college to win. I actually see that as being the most likelihood to play out. That
Well, it's happened
Sanders-
before, as in less time.
I'm
Now-
just getting sick of people in their 70s being president. But
Did you hear that? You better repeat that louder.
I said I'm getting sick of people in their 70s being president. That's all.
Yeah.
Okay.
Well, I mean,
So,
This
wait a
is-
minute.
This is an
I mean, Reagan
Hold
was
on
the
one
oldest
second.
president. He had
I just got a
dementia
note.
last
yeah,
year.
dementia. I know.
I just got a notice, just so bear with me for like 3 more minutes because we didn't do the 100,000. Terry, we're in overtime now, and the hotel charges. Please wrap it up. But I gave all the wait staff a book.
That counts.
So they're going to give me 5 extra minutes, okay? So I got to go to my once and always last question because this has been fabulous. With $100,000, Diane, well, we're past mortgages, pay off your credit card, all that kind of stuff. What would you do with 100,000 risk dollars this year?
I don't pick stocks, and I have to be very careful about companies. You know that. So if I could figure out a way, and I'm sure these two people will tell me how, this is an election year where you've got a billionaire buying Super Bowl ads. I mean, this is phenomenal.
In a
the kind of-
party that
So,
vilifies billionaires.
wait, they're
Yeah,
yelling at me. So what's your,
So I think being able to leverage the advertising revenues that are going to be spent
Good point.
in an election year is, to me,
Could
one
be a
of
big
the
number, too.
Media
it's a
stocks.
big number. This is something blowing out anything we've ever seen. I mean, when Bloomberg heard that Trump had an ad on the Super Bowl for 30 seconds, he pulled out some chump change, $10 million for a 60-second ad. I mean, that's just not something we've seen before. And the kind
good,
of
maybe
spending we're
journalists will
gonna
get a
see-
raise, right?
There you go.
Okay.
That's where I think.
Okay, do
It's a
you
great
want to
point.
give me
And
any
an
other?
Olympic year, so that
It's
adds to
Olympic year,
spending
too,
too.
yeah.
Olympic year,
Great
okay.
point. That's a great point.
Do you want to give me any other areas in the market?
Me?
Yes,
No.
because I haven't filled up my square here on my chart. Last year you gave us a lot.
I know. I am concerned, as Geoffrey is, and I'm still long the stock market. So I'm clearly, my 35% bet is there.
But nothing special you want to tout everybody into?
No.
That you have to account for next year?
No.
Okay.
No, just
Dr.
the
Bob.
advertising dollars. Put it all in that.
Advertising, okay.
Into all the media companies and any place that's going to get money.
From advertising.
Facebook gets a lot of money from political advertising.
Dr. Bob?
I don't think they should. But that's
What's
another
your 100,000, Dr. Bob?
Well, so 2020 is the Chinese zodiac year of the rat.
It's the year of the rat.
Rat.
It is.
And it's also a presidential election. You just can't make this stuff up. It's like too easy. So I remember last year when I told you that we were in the 3rd year of a presidential election cycle, and
Yes.
that markets soar, and a lot of people sort of snickered at that. Well, there's something even more important in the 4th year of a presidential election cycle. In the 4th year of a presidential election cycle, the best sector performance in our stock market is the financial services industry. And the second best sector performance is the utility industry. And if you think about it intuitively, those are two highly regulated industries. And in the 4th year of a presidential election cycle, nothing gets done.
Okay.
And
Nothing gets
which
done right
means less regulations, less chance of new restrictions, new regulations. So to me, I'm taking that 100,000 and splitting it in both of those industries. I'd put $50,000 in the ETF for financials, XLF, which is the SPDR financial industry, and the other is XLU, which is the SPDR ETF for the utility industry. I think I think that'd be a great place to have my money in 2020.
Okay, and for you, Jeff, this is not so
emerging
theoretical.
market.
Can we
All
just
right.
buy, can retail investors buy your Schiller Cape fund?
I'd have my U.S. stock exposure at 20%, and I would use DSEEX, that is the double-line Schiller fund. It's my favorite stock fund.
Is
and-
that a no-load retail investors can buy it?
Yeah.
Double line Schiller Cape fund?
DSEEX, it's just
Okay.
a no-load mutual fund. I would put 50% into EEM, which is the ETF for emerging market equity, and I would put the remainder into gold.
Ah. Okay. Well, that's an interesting note, and obviously we could have questions all day long. And the audience, I've never seen the audience sit this still all the way to the end. I thank the panelists so much.
My name's Scott Robinson. I'm Managing Director at Robinson Resource Group, and we are a proud sponsor of the Executives Club. It's a place where a very small but mighty boutique search and executive coaching firm can feel like people at the dais, feel like people out there, and feel like big business, even though we're small business, and a lot of you are customers and clients, and we appreciate that very much. I'm trying to give a closing really fast here. So Terry, Geoffrey, Diane, and Bob, Dr. Bob, thank you for your advice and counsel there and insights. You know, Terry, your 40 years here is amazing. I love that. Diane, thanks for reminding us about irrational exuberance in the universe. I love that. Dr. Bob, your NOMO, FOMO, JOMO thing was pretty cool. I love that. And Geoffrey, I love the fact that we can all look forward to You Ain't Seen Nothing Yet 221 election. So with that, could we all give everybody up here on the front another applause? And to all of you out there, I hope that you enjoyed today's discussion as much as I have. It never ceases to amaze me how much fun this is. And please reference your brochure for upcoming events for the Executives Club. Refer to the website at executivesclub.org. And I thank you all for being here, and this 2020 Economic Outlook is now adjourned.
See you next year.